Good afternoon, everyone. Today, I would like to take you through one of the topics that we covered this semester, financial statements. It is a requirement according to International Accounting Standard Number 1, presentation of financial statements, that all registered companies should produce a full set of financial statements. A full set of financial statements, therefore, should include statements like the income statement, which is called the statement of comprehensive income. It should also include the statement of financial position, formerly known as the balance sheet. It should also include the statement of cash flows, the statement of changes in equity, and the notes to these financial statements. Let me give you a brief explanation of each and every one of these financial statements, starting with the statement of comprehensive income. This is the profit and loss account. The purpose of a statement of comprehensive income is to measure the performance of an organization for a given period. This could be a month, 6 months, or over a year. Therefore, you would find that an income statement is prepared for a period. The purpose of this financial statement is to calculate whether the business has made a profit or a loss. This is where we have our revenue from our operations. We less all the expenses that we have incurred during the generation of this revenue, and the resultant figure will give us our net profit or our net loss. The second financial statement that I would like to talk about is the statement of financial position. As opposed to the income statement, the statement of financial position is prepared at a specific point in time, at a specific date, and is therefore prepared as at, unlike the statement of comprehensive income, which is prepared for a period. The financial position of an organization, which is reflected by the statement of financial position, is merely a reflection of the accounting equation, whereby what we are saying is the capital that was employed by the owners of the organization in terms of capital, plus the borrowed funds in terms of long-term liabilities and short-term liabilities that were borrowed to aid to the equity that is brought in by the owners, should then be used to acquire assets that are going to be used in the business for the generation of revenue. Therefore, you would find that at any one point in time, capital plus our liabilities should also equal our assets. This financial statement will reflect the position of the organization at a specific point in time. The next statement that I'm going to talk about is the statement of cash flows. Statement of cash flows is one of the most important financial statements. Why? Because we find that when we are preparing our statement of comprehensive income, we use what we call the accruals basis. The accruals concept allows us to consider items like prepaid expenses, prepaid incomes, and depreciation. These transactions, even though we may have incurred some expenses, but we may not have paid for them. Even if we have earned income, but at times we may not have received that income. However, these items are all included in the compilation of net profit in the statement of comprehensive income. Unlike the statement of comprehensive income, the statement of cash flows will only consider cash items, the movement of cash in and out of the organization. Therefore, it disregards items like depreciation, prepaid expenses, prepaid incomes, and only take into account actual movements of cash. Why it is so important? Let me give you an example. Let's take, for example, if we have got our creditors that we owe some monies for the supply of goods, if they are all to come at once demanding their dues, at times we may not be able to settle all the obligations at once. Why? Because some of our monies may still be tied in our debtors. We have sold goods on credit, but we haven't been paid by our debtors. The income statement would have considered all those sales as revenue received. But in actual fact, there is no actual cash received. Therefore, the cash position at the bank will be totally different from what is being reflected in the income statement. And if you are not careful, this can mislead our stakeholders. Therefore, this statement of cash flows serves the purpose to reflect the actual position in terms of our cash position. Then the fourth one that I'm going to talk about is the statement of changes in equity. This financial statement is targeted at the owners of the business, the investors who have actually invested in the business. It shows the changes, the movements in their investment, whether they are generating revenue to increase their stake in the business or not. Then lastly, I would like to talk about the notes to the financial statements. Sometimes these figures may not mean a lot to non-accountants. Some people may not even be able to interpret them. Therefore, the notes to the financial statements are there to aid these financial statements, to give some explanations to these financial statements, and to even give an explanation to some of the treatments that would have been used during the preparation of these financial statements. They also include the accounting policies that have been used. They also include some of the concepts that were used in the calculation of those figures, so that the users of these financial statements will then be able to see the actual vision of what is being reflected in these financial statements. I thank you.